How'd you read a balance sheet? I guess you don't know. That's why you're watching this video. So let's get right into it. It's going to be easy, straightforward, simple. By the end of this, I hope that you will be able to read a balance sheet very easily with no problem. So don't get overwhelmed. Let's just get right into it. So when you look at a balance sheet, basically, you have first the assets listed and then the liabilities. So assets are what you own, you own, and liabilities is what you owe. So your debts, basically. So your assets is what you own, and your liabilities are what you owe. Very simple. The assets come first, then the liabilities. Well, let's get right into it. When we look at assets, we have basically two divisions. The first division of assets are what are called your current assets. Current assets are things that could be turned to cash within a year, typically. So let's look at, in this case, for this company, RCI Hospitality Holdings, which is a strip club owner as well as a restaurant company, so they own strip clubs and restaurants. We can look at what they have for their current assets. So if we look under current assets, now remember this is a snapshot in time, so this is saying on September 30th, 2022, this is what they owned, and this is what they owe. Well, let's look at it. For current assets, which are things that could be turned to cash within a year, they have in total 51 million. This is in thousands, so this is $51 million in current assets. They have $51 million worth of stuff that could be turned to cash within a year. Of these current assets, they have 36 million in cash. You see that? They have 8.5 million in accounts receivable. Now, what's an account receivable? It means it's payments that they are expecting over the course of the next year. So an account receivable means that they're expecting this money to come in basically over the course of the next year because they've already delivered, let's say, the service or whatever it may be in this case. So accounts receivable is basically it's basically cash that they're expecting over the course of the next year for services or products that are already delivered. So people owe them this money, so they're going to be getting this money. This is not stuff that they owe, this is stuff that they're owed. So of these current assets, they have 36 million in cash. They have 8.5 million in cash that's going to be coming in over the course of the next year. Notes receivable is similar to accounts receivable. The only difference is notes receivable is interest bearing typically. So these are quite similar and quite related. The only difference is this number here is basically similar to that. It's just typically a little bit more formal in terms of what's owed and also typically bearing interest. Inventories is straightforward. So this is stuff that you have. Like let's say in this case they're a strip club, or they own strip clubs. So let's say inventories would be things like, I don't know, alcohol that they have, or it could be things like for the restaurants it could be food. So it could be anything that they have in their inventories basically, and what it's worth at fair value or cost or whatever they choose to value it at. So again, we're looking at the asset section first. The assets are divided into two parts: the current assets, okay, and then the non-current or long-term assets. So the current assets, we looked at cash. Cash is cash. It's straightforward. It's how much money they have in the bank. Accounts receivable and notes receivable is what's owed to them and what they're likely to get over the course of the next year. Inventories is the stuff they have. So let's say we're talking about strip clubs. So like alcohol, for example, we can say, okay, how much alcohol and other stuff do they have in their inventories? That's what inventories is. And the other thing is, it's important to note, this is not the only part of the balance sheet you need to read. You also need to read the notes, which will explain in detail what those specific inventories are. So it'll say, okay, out of this $4 million odd of inventory, 2 million is alcohol, a million is, I don't know, non-perishable snacks or whatever the case may be. Prepaid expenses is basically stuff that they've already paid for that they're expecting and services that they'll receive over the course of the next year. That's $1.5 million worth. And then assets held for sale is basically other assets that they're expecting to turn to cash within the course of the next year. In total, for the current assets, we see they have about 51 million in current assets. That's stuff that could be turned to cash within the course of the next year. So $51 million of assets that can be turned to cash easily within the course of the next year. So that's current assets. What's non-current or long-term assets? That's stuff that it's going to be harder to turn to cash, meaning they can't turn it into cash within the course of the next year. Property and equipment is what it sounds like. So properties, things that are a little bit harder for them to convert entirely into cash. Net means after you depreciate the item. So whenever you own something, typically like things like properties, they're going to be depreciated over the course of their life. Net means minus that depreciation. So property and equipment, they have $224 million worth of property and equipment net. So after depreciation. Again, this is a long-term asset because it's not something that can easily, quickly turn to cash. Operating lease right of use assets. We won't go into operating leases because they're a little bit more complicated. Maybe we can even make a video on that on its own, but just think of it as basically they have the right to use certain properties, and so that has a value attached to it, and that's why you see it basically here. Notes receivable, net of current portion. Again, that's things that they're owed basically, but they won't be receiving money that they won't be receiving over the course of the next year. So it's considered a longer term asset. Short term assets, remember, current assets or short term assets are assets that can be turned to cash or will be cash within the course of the next year. Long term assets are things that are going to take longer to turn to cash basically, aren't as easy, aren't as liquid. Goodwill and intangibles are basically non-tangible, non-material things. So goodwill is when companies buy other companies, they will typically pay above the book value of the company that they're purchasing. Anything that they purchase, whatever they purchase the company above its stated book value for, will be considered goodwill on their own balance sheet. So this is basically the goodwill in this particular case is what they have historically paid above the book value of other companies for in acquisitions. And then other assets are other assets. Typically, if you look on the notes to the financial statements, which would be, obviously further down, it will explain in detail what these other assets are typically. It's important, very important, that you look and read the notes to the financial statements, not just this part, because the notes will specify, okay, the inventories, these $4 million odd worth of inventories are made up of, like I said, maybe $2 or $3 million of alcohol, $1 million of other stuff. It'll say, okay, the accounts receivable, we're going to be getting them from like 20% from this guy, 20% from that guy, and 10% from this guy, and we're likely to get them all. So you got to read the actual notes. You can't just look at this and you'll get a good amount of information, but to really understand the business, you have to read also the notes. Okay, so that's assets. So total assets is the current assets plus the non-current assets. That will give you the total assets. Liabilities, maybe I'll just change my pen color here just to make it a little bit nicer, is what you owe. So current liabilities is basically what they've got to pay over the course of the next year. These are accounts payable, so services that they receive that they now owe money for and have to pay them over the course of the next year. Accrued liabilities is similar. Current portion of long-term debt basically means what they got to repay their debt. So what amount do they owe over the course of the next year is what this is. Operating lease liabilities, it's again, I don't want to go too in-depth about leases because it's a little bit more complicated, but suffice to say this is what they owe on their leases over the course of the next year. You can think of it just as a liability for simplicity. And then total current liabilities is just simply adding up these numbers and you get your total current liabilities. So this is how much money they owe over the course of the next year. Now, these are their longer-term liabilities here, which are basically their non-current liabilities, and then you can see the total liabilities listed here, which is this current liabilities plus these other liabilities. The biggest liability on a balance sheet almost always is going to be your debts. This is how much they owe to banks and other people and entities that have financed them. In this case, they owe $190 million in debt. So this is almost always the biggest part of the liability section on the balance sheet, unless they have very little debt. So you can see what they owe over the course of the next year is $31 million, but over the longer term, they owe a lot more than that. And then their total liabilities, in this case, about $289 million. Using this information, the question is, how can we look at a balance sheet and see how healthy a company is? That's a very important question. Typically, you want to compare some numbers. The first two numbers that you're going to want to compare is going to be the current assets, so in this case, $51 million, with the current liability. So how much money they're expected, or how much money they have that can, or how many things they have that can be easily turned to money, or are money, or can be easily turned to money over the course of the next year compared to their total expenses, or their total liabilities over the expected upcoming year. So in this case, they got $51 million over $31 million of liabilities. When this ratio is greater than typically 1.5, that's a sign of good financial health. So if we look at it in this case, they got $51 million of current assets divided by 31 million in current liabilities. They got a current ratio of 1.64, which would be considered typically healthy. But again, you're going to have to look at, okay, of these accounts receivable, how much are they likely to actually get? Now, typically they're already accounting for bad accounts, but you want to make sure by reading the notes of the financial statements. The other number that you want to look at typically as a sign of decent financial health is their total assets compared to their total liabilities. So this just basically means, okay, if we look at how much they own compared to how much they owe, what does that look like? And you're going to typically want this number to be positive. That number, like we said, total assets minus total liabilities is called your equity. So if you see here, equity, I'll highlight it in green just to make it a little bit easier for you guys. So here, this is your equity. What your equity is, it's your assets minus your liabilities. So if we do, in this case, they got $530 million in assets minus 288 in liabilities. We get this number here, approximately $242 million in equity. So all their assets minus their liabilities is their equity. Another way of looking at equity, which is typically the preferred and more conservative way among investors, at least as an initial screen, is looking at their assets but minus their liabilities, but not counting intangibles or goodwill as part of their assets. So if we see here goodwill and intangibles, remember I said that these aren't tangible things. These are things that they've paid. So when you buy a business, anything that you buy the business for more than this equity would be considered goodwill. If we take goodwill and we eliminate intangibles, and we then calculate our assets, minus all these liabilities, we then have what's called tangible book value. So in this case, we said the assets were 530 million approximately, but of that, 67 million is goodwill, and another 144 million is in other intangibles. So in total, we have 319 million of tangible assets because we took out these two intangible items. If we now subtract all the liabilities, 288, we'll get 31 million in tangible equity. So this was our equity, but our tangible equity is actually only 31 million when we subtract these intangibles. So again, just to go over the structure of a balance sheet, you have assets and then liabilities. Assets and liabilities are divided into current and non-current. So you have your current first and then your non-current. Same thing with liabilities. You have your current and then your non-current. Your current is what is cash or can be turned to cash easily within a year. Your liabilities are what liabilities are expected to come up over the course of the next year. Long-term liabilities are liabilities that are not expected to come due over the course of the next year. Your equity is your assets minus your liabilities. Your tangible equity is your tangible assets, so assets taking out goodwill and other intangibles minus all your liabilities. So that is a breakdown of how to read and interpret a balance sheet. Again, the important thing is don't just look at these numbers here. Also do a little bit more research into what comprises them. So for the inventories, be sure to look at, okay, what actually makes up these numbers? Where are the inventories? In what items and so on. Same thing for the accounts receivable. Look at, okay, who is going to be giving us this money? Is it just one company? Is it a company that's going to go bankrupt? Like, you have to know these things and do that sort of research as well. So I hope the video was informative. If you have any questions, I'm happy to answer them. Please leave them in the comment section down below. Thanks.